All right, everybody. So today we're going to talk about day trading terminology, and the term of the day is moving averages. And we're actually going to be talking about simple moving averages and exponential moving averages. So plural moving averages and the two different types. All right, now this is actually one of my favorite technical indicators. It's very simple, and for me, I'm all about keeping my charts simple. I don't want to overcomplicate it. I don't want tons of indicators. You guys have probably seen people on social media and stuff posting charts, pictures of charts that are really complicated. I just don't find it necessary. I've got a couple charts on here that I can load that are a little busier. This one's, I mean, this isn't even that busy really when we think about it, but you can get a little bit more complicated on some of these, but for me, I've always done well keeping it simple. And I'm a trader who in the last 6 months is up over $200,000. So this goes to show that you don't need tons of technical indicators in order to be profitable. If you keep it simple, you can do really well. So one of the moving averages that I use almost every single day is the 9 moving average. And I show this to you guys pretty much on every chart. It's this gray line right here. I use the 9, the 20, and then the 200. These are all exponential moving averages. All right, so let's talk about what these are and how they work. All right, so the term of the day, moving averages, sometimes called MAs or EMAs. Now, a simple moving average is very simply the average price over a set period of time. So if you're looking at a 9-period moving average, you're looking at the average price over the last 9 periods. Now, if you're looking at a 1-minute chart, the average price of the last 9 1-minute candles is going to be different than the average price of the last 9 daily candles, for instance. So your moving average prices will change depending on which time frame you're looking at, and that's why I always have the moving averages on all 3 time frames that I use: the 1-minute, the 5-minute, and the daily. Of course, some traders use the 15-minute and the 60-minute or whatever, and they would have the moving averages on those time frames as well. Now, in contrast to a simple moving average, we have the exponential moving average. Like a simple moving average, it's based on a set period of time, the 9 period, the 20 period, 25, whatever it might be, and it's giving you the average price over that period of time. The only difference, and this is an important difference, is that exponential moving averages weight current price action heavier than older price action. So what does that mean? That means that current price action is going to cause the moving average to move quickly. So the moving average moves faster in response to current changes in price. And you can see this example right here where I have my exponential gray moving average moving up. And you can see the yellow is the simple. The simple was a little slower to start moving up, and then it was a little slower to start slowing down, right? To start coming back down once the price dipped. So that's what I really like here about this exponential moving average, is that when the price pulled back quickly, this moving average had a quick curve to it. It quickly pulled back down, whereas the simple is much more gradual, much more, just like a smooth ribbon. And the exponential as a day trader moves faster. That's the 9, and these are both 9 period. This is the 20 period exponential in blue-green here. And you can see it's a little quicker to respond to the price, but being that it's a longer period, it's always going to be a little bit slower than the 9. Shorter periods move faster than longer periods. But in any case, you can see here that the 20 is curling up, and then it starts to come back down, whereas the simple moving average, here the thinner line in orange, is a little slower to start going up, and then a little slower to start pulling back down. So as a day trader, I find the exponential moving averages work really well, and I find that they're really well respected on the intraday charts, especially the 5-minute chart. The 1-minute time frame is good as well. I use these moving averages on that time frame, but the 5-minute is really where I find the strongest setups, and this is, of course, a 5-minute time frame right here. Now, if we back up out of this and we can zoom into one of these charts here and just sort of look at the differences between these moving averages. Now, for me, I'm using them not just on the intraday charts, but of course also on the daily charts. And it really is incredible to see how well respected these moving averages can be. When we see price come up and just tap the moving average almost to the penny, it really is a reminder that thousands of traders are watching these same exact price points. So let's look at a couple. LPTN. Okay, I've already got this up. So let's back up on this one. Actually, what I'm going to do is I'm going to show you a slide that I have here. All right, so this is LPTN. This is a ways back. And look at on this day how the price came up right here. It came up to the 200 moving average. It tapped that level, and then it pulled back off that level. It's not a coincidence. When I'm trading and I see the stock coming up to this moving average, I see this as resistance. So this to me is a point of resistance. So the price coming up here and running into it and not being able to break over that level, that's predictable. You can see here on the other hand, the 200 moving average, the purple line, is forming support. The price first breaks up above it, and then often we come down and we retest support. So we test that level, right? And we bounce off it, and then we're off to the races. Well, we end up coming down a few weeks later, maybe a month or two later. We come down, we bounce off it again. Then we move up. We come down, we bounce off it again. So this is becoming a very well-defined level of support. Traders are really respecting it. In fact, they're respecting it quite a bit more, really, it seems, than like the 50 moving average, this red line, or the 20 or the 9. So sometimes we'll notice that for whatever reason, one particular moving average is being respected more than the others. And that may be for any number of reasons. It could be that there are some large institutional traders who are trying to buy around the 200 moving average because they see that as sort of a safe entry point. They're putting in their buy orders and they're creating support. If you have a couple of those guys using exponential moving averages, well, then that's the one that's going to get respected. On another stock, maybe it will be the simple moving average that gets respected. It sort of depends, but generally you will see that moving averages are respected. It just can vary stock to stock which one is kind of in the most control. Now, an example of a stock we saw just yesterday was LEI, and we look at the daily chart on this one, and in this case, it happens to be the 50 moving average that's being really well respected. See how the price came up and tapped it and then pulled back. We tapped it and then pulled back. We tapped it and then pulled back. So this has happened once, twice, 3 times, almost a 4th time just yesterday. As soon as I saw it popping up yesterday, I was like, no, I'm not going to buy this because it's going to run into resistance right here at 160. It's too close. It's too nearby. Now, if we can break over 160, then we have room from 160 up to the 200 moving average. So that's the next one. And again, there will be some traders using 100 moving averages and traders using 120 and 200 or 250. It's true that if you looked at a different moving average, you would see different areas of resistance. I focus on using the ones that are the most common among traders. The big difference, of course, is that some traders like simple and some like exponential. So if we change this to, let's see, just for instance, if we change this to an exponential moving or a simple moving average, it does change it a little bit. It clearly looks different than when it's exponential. To me, the exponential is the one that's kind of getting respected more in this case. But again, this is what I use as a trader, and for the sake of consistency, I just keep it, keep it easy and use just the exponential moving average. Now, as far as intraday charts go, I'm primarily using the 9 and the 20. I don't use the 50. I don't feel that it helps me or that it's really necessary. I just, again, keep it, I'd say keep it simple, but I keep it exponential and just use this 9 and the 20. I don't want to overdo it and have things too complicated. All right, so in this case, you can see the way the price pulled back here to the 9 EMA. That for me was a buying opportunity. I love that. I love seeing that type of pullback. And that for me is really, it's almost the perfect bull flag when we have that consolidation over and at the moving average. It really is just exactly what I look for in the strongest bull flags. I'm going to show you a couple of examples here of bull flags that I've traded. This is one here, and you can see how clean this is. The move up, the pullback to the moving average right here, First candle to make a new high is your entry, stops at the low. This is based on the moving average pullback. Now, in this next example, I wouldn't buy up here because of how extended we are off support. Moving averages are levels of support and resistance. So I like to buy near support and sell as we squeeze away from it, right? That makes sense. Or short as we're far away and cover as we come back down if you're a short seller or you like reversals or bottom bounces as well. So here you get the spike up, first pullback, entry, squeeze here. And although this is a bull flag pattern, which is a specific, type of strategy, and this stock has to be the right type of stock to trade, meaning it's got low float, it's got a catalyst. We're talking in this terminology session specifically about moving averages, but one of the things that you'll realize is that all of these lessons do sort of, compound onto the next one. So this is part of building your foundation. One thing affects another, which affects another. So building your knowledge as a trader requires you to understand how all of these different things interact. And you need to understand moving averages. You need to understand candlestick patterns, the bull flags, the flat top breakouts. You need to understand the right type of stocks to trade. Those are going to be ones that have the potential to move 20 or 30% intraday. There's only certain type of stock that has that potential. You need to learn how to find it. That means you need to know how to use stock scanners, right? You need to be able to find those stocks that have big potential, jump into them as early as possible, understand risk management, et cetera, et cetera. But when it comes to the moving averages, for me, I use them just simply as this level of support. So the pullback to the moving average, entry here, sell through the high, pullback, entry here, sell through the high. This is another one, squeezing up, the pullback, entry, stop at the low, selling through the squeeze. And these are stocks that I would find right off my high-a-day scanners. This is another nice pullback, a squeeze up, pullback, entry right here. So this really is important for me to understand whether this stock is too extended or not. If I didn't have the moving average there, I wouldn't really be able to understand the context. So that's what it helps me understand. It helps me see context. It helps me see kind of the big picture. Is this stock too extended, or is this a safe place to get in? So, in this case here, we are a little bit extended. We ended up getting a little bit of a false break. All right, so we'll back out of that here and switch over to Fred. We'll look at this one today, or yesterday actually. So one of the things that I do, when I trade reversals, there's two different ways that you can trade reversals. One way is to short as close to high of day as possible, like way up here in the top of this type of candle, and cover on the move back to the moving average. All right, so this to me is that rubber band snapback setup where the rubber band is super stretched out and you want it to snap back. So my target is the moving average. It's the 9 moving average on the 5-minute and the 20 moving average on the 1-minute chart. So in this case here, we were watching this short, I think it was right around here, something like that. So this ends up dropping down, popping back up, dropping down. So if you took the 1-minute setup with a stop at high of day, 2035, this ended up moving down to 1876. So a pretty decent pullback when you think about it. Some traders are going to use this 1-minute setup. They're going to short off the high and cover on the move down to the 20 moving average, knowing that most stocks will bounce off this blue line. This one ended up not really bouncing off that line. It broke below it, popped back up above it, but then you can see right in this area, we were kind of forming some resistance. Right? That blue line was resistance. And that's important. When you see a stock break below this line, now you set your stop on the other side of the line. So if the stock now breaks up above, the price breaks the moving average, then you're going to stop out. So some traders, instead of trading the short from the extension down to the moving average, they wait for the moving average to break, and then they take a short position like right in this area here. They get short right in here, maybe not on this first drop, but after we pop back up and then confirm and make a new low. And then they hold until the stock breaks back over the moving average in the other direction. So in this case, they'd be back, they'd be covering their position right here. But of course, in other cases, when you have a longer term pullback, those can be a bit stronger. This one, didn't really give us the cleanest pullback on that day. It just sort of dropped down and then ended up meandering higher, and overall being a fairly strong setup. This here is another example of a pullback, and this stock just was pretty much staying right below that 20 moving average. So anytime we popped up to the moving average, this was also an opportunity to take a short and then stop on the other side of it. Very similar to the way I would buy a long position on the pullback to the moving average, right? You can short on a bounce up to the moving average and then just ride this momentum down. This down here is a bottom bounce opportunity. The first target is a move up to the moving average. That's going to be a quick trade, a little bit of a scalp off the low, and other traders would instead wait for the first time this actually breaks over this moving average and holds, because when that happens, you can see it's going to be significant. It hasn't broken and held over that level all day long. So by the time it does it, that's going to signify a real shift in trend. So that's sort of the thing with reversals and how moving averages come into play. You can either take the rubber band snap, or you can take more of a trend reversal, where you're really looking at a shift in momentum, the tide shifting, and you don't get in, right off the bottom for a scalp. You wait for the shift over the moving average and then ride the moving average as it comes back up with a stop just below it. This one here's another example where we had a stock that was pretty weak. Now on the 5-minute chart, we had this long period of selling, but there wasn't, to me, the clearest entry for a reversal because of the way, I like when I do a 5-minute bottom bounce to have at least 5 to 7 consecutive red candles. But we had that down here, but then we kind of went sideways and then washed out again with peaking volume at the low. So you can see on the 1 minute, yes, you ended up getting a pretty big bounce right here, but who's to say it was going to happen there and not, here, here, and here. So when you're sort of watching these selling off, when it's not consistent, I usually don't trust trading on the 1 minute chart. So I say, okay, well, I'm not going to take that 1 minute bounce because we don't have enough consecutive red candles. Now, if we had, when we have a setup where we've got 10 consecutive 1 minute candles, then I'll jump in on the 1 minute chart. That's fine. But this is one of those cases where we didn't have that. So just to give you a sense of what it looks like when we have all those consecutive candles, this right here happens to be the 5 minute. But let's just say this was the 1 minute. This is a time where I would go ahead and short. I would short on the 1 minute because it's so obvious the first candle to make a new low is going to be, a significant point, a spot worth taking a trade on. This is another one here that you can see. This one on the side happens to be a 1 minute where we have this long sell-off. First 1 minute candle to make a new high, stop on the low. It's a 2-point bounce. So that's a time I would take the 1 minute chart. But in this case, it's just kind of grinding lower. I wouldn't feel safe taking the 1 minute. It bounces right up to the 20. However, I would be interested in the trend shift where I get in for the break of the 20 moving average. So here we break above it, and now this is kind of the point. Are we going to hold above it? So I would consider right here an entry, now that we're kind of consolidating right at that level, an entry over 22.72 with a stop at the low. It's about a 30-cent stop. Looking for the break over the moving average, and now you can see here the trend is starting to shift. Now we've broken, for the first time in quite a while, we've broken over this moving average. So this is significant. Now that we've broken over it, I would move my stop up here to just below the moving average. So with my entry at 72, I've now got like a 20, maybe 15-cent stop. And now you can see this is kind of riding, and now it's holding this moving average and riding up. So we can keep adjusting our stop. Now we've got a profit stop, moving it up just under the whole dollar, and it continues along. So now this level that was resistance has become support. Again, though, it's important to understand that you can't use the moving averages on every single chart. This is a stock that had really high relative volume. So it comes back to you have to trade the right stocks. If you try to trade, moving averages with, the SPY or something like that, you're going to see a lot more of this type of stuff where it's just breaking them up and down. This is not really respecting the moving average that much. right? I mean, maybe at times, but for the most part, it's in between all over the place. This is a stock that does not have high relative volume, right? Today the volume was lower than average coming into the holidays. That makes sense. But the important thing to take away is that the only stocks worth day trading are stocks that have high relative volume. And why is that? It's because stocks with high relative volume have thousands and thousands, tens of thousands, maybe even hundreds of thousands of traders watching that stock. That means the breaks of moving averages are going to come with more volume. They're going to be the logical levels of support and resistance are going to be well respected because you have traders there who respect it. On a stock that doesn't have high relative volume, some of this might end up becoming algorithmic trading, high frequency trading, and the drops and pops are not even related to an actual trader watching, any particular stock. It's just kind of the ups and downs of the overall market. So that's why I really encourage traders, to make sure they're using scanners like these, where you can go in and you can just immediately filter out everything that doesn't have high volume, and that way you're focusing on setups that other people are watching. If you're thinking about taking a bottom bounce, why does a bottom bounce work? Like back on CC, it works because thousands of traders are buying at that same spot, right? That's why it works, because thousands of traders recognize, okay, the trend is shifting. It's going to bounce. All of this volume here is what we look for. The peaking volume on the downside and the volume coming back up. And it's no different on the smaller cap stocks, the low price stocks. These are the same way. And I can scroll back on this one a couple days, and you can see that we had a really nice breakout. And during that breakout, the 9 moving average was very well respected. So safe entries on this at support. Here's a support level right here. So I look for the consolidation at support and I buy here. This is an entry at $10. Where's my stop? It's right down here. It's a 20-cent stop, 25 cents. Selling through the high, selling on the extension away from the moving average up to a high of $12 and then pull back to the moving average. All right, so now the low is 11.25. Entry at the first candle to make a new high, which is this green candle as it breaks over this candle. So your entry is 11.65, stop is 11.25, 40-cent stop, and now selling through the push. Now we're through high of day of 12, and we go up to a high of 13. So 11.65 to 13, that's a $1.35. That's a really nice move versus the 40-cent stop. And you can just do that all day long. And it's by using the moving average. You don't need anything else on your chart. You don't need MACD. You don't need RSI. You don't need stochastics. You don't need that stuff if you have your moving averages, right? Moving averages and candlestick patterns. That's really all you need. But of course, you also need to be able to find these setups in real time, understanding, the criteria of stocks that have home run potential. And, that does take practice. So I wouldn't discredit the value there, but just to say, you can keep your charts very simple. You don't need to overcomplicate it. The only other indicator that I use from time to time are Bollinger Bands, and I use those for one specific purpose. I use those because I know that when the price is trading outside the Bollinger Bands, the stock is experiencing extremes, right? When we put these Bollinger Bands on, you're going to see that almost all of the price action is inside the Bollinger Bands. So if you have a candle that's way up here outside the Bollinger Bands, that's an extreme, right? And that's a good place to take a reversal trade, to take a short with a stop just above the high, because there's a really, really good chance that that stock is going to come back down and is going to come inside the Bollinger Bands, right? It can only trade outside those Bollinger Bands for so long, before it's finally it's too extended. So as an example of that, let's see, I think I've got a good one here. Yeah, here's a good one. So this is a stock squeezing way up outside the Bollinger Bands. That candle outside the Bollinger Bands, it's really uncommon to see that. And so when I see it, I take a short, covering on the move back down to the moving average. And then, of course, once we get to the moving average, some traders may take that momentum shift trade for the break of the moving average, but by that point, I would already be up a lot from the short when it was so extended. And I always find these to be easier to identify. It's easier to find stocks that are really extended because I can use my scanners, right? These reversal scanners. To find a stock that is consolidating, at the 20 moving average and maybe getting ready to break over that level, that's not as easy to do. You'd really have to be watching that stock all day long. The good news is that if you focus on a strategy of trading, the top four highest volume stocks each day, highest relative volume, then you can watch those four stocks all day. And when you get these types of shifts in momentum, there's a good chance that you'll catch it. And because it's a stock that's in play, thousands of other traders will be watching it as well. All right, so I hope this has been a helpful terminology session. If you guys do have any questions, you can always email me or put comments down below. All right, thanks, guys.
Let's be honest. If you made it this far, you must have really enjoyed that video. So what's stopping you? Subscribe right here and get email alerts anytime I upload new content. Until then, happy surfing!